This is Value Investing. I'm your host, Jun Kim. In this podcast, you'll learn everything related to value investing. Hey guys, welcome to another episode of Value Investing. In the last episode, we talked about 5 belief perseverance cognitive errors. And in today's episode, what I'm going to do is I'm going to talk about 4 additional cognitive errors stemming from information processing errors. So it's going to be an interesting episode, so stick around. And before I get started, let me just give you a quick disclaimer, as always, that this podcast is for entertainment purposes only, and it is your responsibility to consult with your investment professional for any investment decisions. So without further ado, why don't we get started? So as I mentioned in the last episode, we talked about 5 different cognitive errors stemming from belief perseverance. So I'm going to talk about today another category of cognitive errors, which are coming from information processing errors. So first one is anchoring bias. Second one, mental accounting. Third, framing bias. And lastly, availability bias. So information processing biases result in information being processed and used illogically or irrationally. As opposed to belief perseverance biases that we talked about in the last episode, these are less related to errors of memory or in assigning and updating probabilities, and more to do with how information is processed. So that's the difference between what we're going to talk about today versus what we talked about in the last episode. And if you haven't listened to last episode, I highly recommend that you go back and listen to that first and then come back here for today's episode. And as I also mentioned that we're going to talk about cognitive errors for today's episode, but in the next episode, I'm going to talk about biases related to emotional errors. So both episodes will be very interesting. And these errors occur all the time by investors. So if you know what to watch out for, you can minimize the errors coming from these areas. But you cannot completely eliminate these biases, even if you know and cognizant of the existence of these errors. So that's what's so fascinating. And it all depends on what kind of temperament you have when it comes to investing. And that's what Warren Buffett has been emphasizing in the past. So without too much talking about all these things, why don't we get into today's first cognitive error, which is anchoring bias. So what is anchoring bias? People generally anchor to the first initial number they see or estimate. So let me just give you a quick example. So if you go to a store and you find a nice jacket you like, and you try it on and you like it, and you look at the price tag and it's $1,000, which is quite high. And you're trying to, put it back, and all of a sudden a salesperson comes to you and saying that, oh, by the way, this jacket is on sale and it is now $400. And now you're thinking that, oh, maybe this jacket is cheap because initially you thought that this jacket is $1,000. You're getting 60% discount and now the price is $400. But you have to think a little bit carefully here because you might be tricked into thinking that this is cheap, but it's actually expensive. $400 is expensive. So this is an extreme example, but you can pick any price you like. But once you know and once you anchor to one specific price, it's not easy to change your mind. You can probably be tricked into thinking that this is a good deal. So that's not actually the case. So another example that I want to give to you is very interesting experiment. So in this experiment, people were asked to write down the last 3 digits of their phone number and multiplied by 1,000. So for example, if your last 3 digits of your phone number were 678, then you multiply by 1,000, which is 678,000. And after people were asked to write down this number, what they also were asked to do is to estimate housing prices for specific house. So results show that people's subsequent estimate of housing prices were significantly influenced by the arbitrary anchor, in this case, last 3 digits of their phone numbers. Even though they were given a 10-minute presentation on the facts, figures from the housing market at the beginning of the study. So even if you present exactly the same facts to a group of people based on their last 3 digits of phone number, which were reminded to them at the beginning of the study, the final results of their estimates came out completely in a different manner. So this is a very fascinating study. So you have to think about from the perspective of investing. So when it comes to investing, initial price that you look at when you first purchase your stock is going to be anchored in your mind. So if price goes up, then you're probably not going to buy more because your initial purchase price was lower. And if price goes down, you're probably going to hold on to that stock because you're anchored to your initial price. And this one actually is mixed with loss aversion, which is another emotional bias that I'm going to talk about in the next episode. Also, you can think about intrinsic value. Once you go through a lot of hours to derive intrinsic value of a specific company, you probably will be anchored to that number even after you receive new information. And also rating and recommendations by analysts is going to be anchored to one specific number for a while. So you always have to watch out for this anchoring bias whenever you are making your investment. Okay, so let's move on to the next one. So next one is mental accounting. People treat one sum of money differently from another equal-sized sum based on which mental account the money is assigned to. So let me give you an example. So if you have some money in your checking account, then it's going to be treated differently from the money in your savings account or money in your brokerage account. And at least that's the case for me. And also, if you have some money earned from working, then you're probably going to value that money a lot more than money that you earn from gambling. So you have completely different mental accounts for different types of money that you earn. But if you think about it, they are all exactly the same money, right? So it doesn't make sense from psychology perspective to have this mental accounting. But I don't think that this is necessarily all bad because there are some pros into this mental accounting. For example, it actually will allow you to do the financial planning in the future. You can save money for your college tuition, and you can set aside some emergency funds in case you need them in the future urgently. So those are the pros. And in terms of cons, people tend to spend money easily when they earn from gambling, bonus, tax return, and so on. So think about last time you got your tax return. If you're the type of person who spent that tax return easily, then you're falling into this trap of mental accounting. Also, you probably want to look at your portfolios holistically. If you have multiple brokerage accounts, then you don't individually look at them and try to assess the performance. If you have your individual brokerage account, a 401k, and savings account, all these things, you have to combine all these assets together and then make the assessment in terms of whether or not you are doing the diversification correctly, whether or not you want to increase your stock portion of your portfolio, and so on. Just don't look at individually. So that was something that I wanted to talk about mental accounting. So let's move on to the next bias. So next bias is called framing bias. People answer a question differently based on the way in which it is asked. So people are framed into thinking in a certain way. So let me just give you an example from the perspective of doctors providing advice to patients. And this might be a little bit extreme example, but the doctor can say that 25% of the people with disease X given medicine Z will survive. This is talking from the perspective of gain. You can say exactly the same thing in a different way. The doctor can say 75% of people with disease X will die even if given medicine Z. So this is talking from loss perspective. So even though these two sentences are exactly the same, one is just referring to gain, 25% of people with disease X given medicine Z will survive, and the other one is just opposite, right? 75% of people will die. Even though statistically there's no difference between these two sentences, people tend to go with the medicine if it is framed in the gain context. So people are not rational. Another very interesting example that I want to give to you is Economist magazine. I think I was told this example from TED Talk at some point. I don't exactly know who that person was, but when you have three options from any magazines, the first option is digital option, which is $50. The second option is print only option, which is $80. And third option is digital plus print option, which is $80. So this third option is same as the second option, which only gives you only print only option. Then which one would you choose? People would think that this is ridiculous because the second option and third option prices are exactly the same, and there's no reason to put the second option in here because you can just give digital option or digital plus print option because nobody's going to choose print only option. And you're right because people didn't choose print only option. However, there's a catch here. If you only give these two options, digital only option $50 and digital plus print option $80, people tend to choose digital option a lot more than when they were given these three options. Even though you think that the second option, it has no merit because it's obviously inferior compared to third option, digital plus print option, people tend to choose this third option a lot more when you have this second inferior option in this frame. This is quite typical case for framing bias. So I thought this magazine option framing was quite interesting. So when it comes to investing, you probably gonna be framed into thinking in a certain way by the management. For example, if you look at annual report, the first page you're gonna look at is shareholders letter from the management team. Because if you look at that at the beginning, then you're probably gonna have a very good impression of the company regardless of their performance. So my suggestion is that instead of looking at annual shareholders letter first, just go into financial statements first, because that's going to give you more objective picture rather than looking at nice words from the management team. So that's how you can avoid framing biases when it comes to investing. And also compare the performance against industry peers. Always just have relative performance in place, because if you just look at management's discussion and shareholders letters, then management usually try to put rosy pictures for their investors even if they don't have good performance. So that's my recommendation. Okay, so let's move on to the next one. Next one is availability bias. People take easily recalled outcomes and apply them when making a decision. So when it comes to deciding probability of event, they assign the probability in a wrong manner because whatever they can recall will be outweighed by what they cannot recall. So let me just give you some examples. So right after the financial crisis in 2009 and 2008 and 9, people avoided the stock market altogether because of the bad recent memory of their, stock loss. But if you look at holistically throughout the history, we always had ups and downs in the market. So always you have to look at the entire period into perspective when you try to estimate how much loss and how much gain you're going to have in the future. But if you just because you had recent loss doesn't necessarily mean that you're going to have that loss in the future. And that's quite opposite. You're going to probably likely to gain more from the stock market once you have significant drop in recent years. And if you are interested in one area, you tend to overestimate the importance of that. Volume investors tend to overestimate the volume investing techniques, whereas growth investors, technical analysis investors, overestimate the importance of their areas. So as volume investors, we can always try to adjust our logical thinking if necessary, and always open to the ideas about other investment approaches. So you can develop a disciplined approach when it comes to investing by having some checklist instead of just relying on your recent memory. And also you can look at old investment articles and see what actually had happened in the past. Because what I find quite fascinating is that people always look at recent articles because that's what's happening right now. That's what's on TV. But if you go back in time and look at old articles, then it's a lot more interesting because people paint very gloomy pictures when we had financial crisis. Understandably, that was the case. But back then, people say that it's the end of the world, and people say that the stock market will crash further and we're going to have housing crisis and so on. That was definitely one of the scenarios that could have played out. But when we had a huge crash, the likelihood of the further crash was not that much, at least compared to whatever the things that were depicted in these old articles. Okay, so those are the 4 things that I wanted to discuss today. Let me just go through them quickly one more time. The first one we discussed is anchoring bias. The second one was mental accounting. Third one that we discussed was framing bias, and last one that we discussed was availability bias. So I hope that you enjoyed this episode, and I personally like to talk about these behavioral biases a lot because if you really think about when you lost money, probably it's not due to the errors from intrinsic calculation or errors from your mathematical backgrounds or statistical backgrounds. But many of the errors that we are making as far as investing is concerned are coming from these behavioral biases. So that's why I like to talk about this topic a lot. And I like to remind myself of the existence of these behavioral biases. And I try to look at my behaviors from third person's perspective and see if I making any of these mistakes. I'm 100% sure that I have made these mistakes, and I'm 100% sure I will make these mistakes in the future. But if I understand them in detail, and if I watch out for any of these things, I can reduce the frequency of making those mistakes, and they are very costly. Trust me, they are very costly. So try not to fall into the trap of making costly mistakes because of these biases. So try to remind yourself always of these biases. And first thing you have to do is to know existence of these biases. And second, you constantly have to remind yourself. Okay, so I guess that's it for today's show. I hope that you enjoyed this show. And as I mentioned, the next episode is going to be about emotional biases. And I think it's going to be a fantastic and very interesting episode. So tune it in and see you next time.